When people talk about the 2008 crisis, they usually mention subprime mortgages, Lehman Brothers, maybe Wall Street greed. But beneath those surface-level explanations, something far more human and far more engineered was unfolding. And if you look closely enough, you start to see patterns that repeat in every financial bubble, including the ones forming right now. I always tell people, markets don't move because numbers change on a screen. They move because humans make decisions under pressure. Fear, certainty, arrogance, confusion. Those emotions pump more energy into the financial system than any central bank ever could. And in the years leading up to 2008, those emotions weren't just present, they were weaponized. The story truly begins with a simple human desire, the feeling of security that comes with owning a home. Governments encouraged it, banks monetized it, families dreamt about it. And Wall Street? Wall Street figured out how to turn that basic aspiration into an industrial-scale money machine. The trick was psychological. If you can convince people that prices only go up, they stop asking questions. They stop thinking about risk. They start trusting the system more than they should. And that's exactly what happened. You had banks offering loans to people who could barely afford them, then convincing those same people that everything would be fine. Just sign here. Your house will appreciate anyway. Notice the cognitive pattern. Create optimism, then exploit optimism. Meanwhile, behind closed doors, another behavioral loop was forming. Institutional FUM. If one bank loosened its lending standards, competitors felt they had to follow. No executive wanted to be the one who missed the wave. It wasn't about serving customers. It was about protecting status, job titles, bonuses. In a way, the housing market became a stage where every player performed confidence, even as they sensed the floorboards cracking.
And here's where the story tightens. Banks didn't just give risky loans. They repackaged those loans into financial products, mortgage-backed securities, and their more complicated cousins, collateralized debt obligations. If you're wondering why they did it, think of it like psychological laundering. Take something risky, wrap it in layers of complexity until nobody feels responsible for it, then sell it to investors who believed the rating agencies, not the underlying reality. Even the analysts rating these products fell victim to a classic bias: the assumption that because something hadn't collapsed yet, it never would. You see how human this is? The world's biggest financial institutions were making decisions with the same brain wiring that makes us double down in a losing game because it has to turn around eventually. But the tension was building, quietly, invisibly. These mortgage bundles were like bombs with randomized timers. And yet, Wall Street kept stacking them higher because the short-term profits were irresistible. Let me ask you something. Have you ever seen someone chase a reward so aggressively that they ignore every warning sign around them? That's what was happening at scale. Now, around this point, something interesting happened. A shift in collective behavior. Whenever a bubble grows, there's a point where people stop analyzing fundamentals and start analyzing each other. Homebuyers didn't ask, "Is this price fair?" They asked, "If I don't buy now, will someone else get the deal I missed?" Investors didn't ask, "Is this asset sound?" They asked, "Is this what the market wants right now?" That's the psychological tipping point where rationality leaves the room and momentum takes control. And still, the machine kept accelerating. Inside major banks, pressure was suffocating. Traders were incentivized to chase short-term gains, even if the long-term risks were catastrophic. Compensation structures became a psychological trap. Large bonuses up front, minimal punishment later. Imagine being rewarded for lighting a fuse, but never being around when the explosion hits. Wouldn't that distort your sense of responsibility? It did. Massively. At this stage, the financial system looked stable on the outside, but hollow on the inside. Like a skyscraper built with decorative steel instead of structural steel. And every bank pretended not to notice. Not because they were blind, but because acknowledging the truth would have forced them to stop the party. And nobody wanted to be the first one to say, enough. Then came the moment when reality finally punched through the illusion. Homeowners started missing payments. Adjustable rates spiked. Mortgage defaults rose quietly at first, then overwhelmingly. And suddenly, those supposedly safe financial products, the ones stamped AAA, started showing cracks. Investors asked questions. Regulators hesitated. Banks whispered to each other in private meetings, trying to figure out who was still solvent and who was already underwater. This is the part people forget. The system didn't collapse because losses occurred. It collapsed because trust evaporated. Once institutions stopped believing each other, the liquidity that keeps markets functioning disappeared almost instantly. Think about that. A multi-trillion-dollar network fell apart because the psychological glue holding it together melted. And as soon as the cracks appeared, fear spread faster than any virus. Investors rushed to pull out. Banks hoarded cash. Lending froze. You could feel the entire global economy holding its breath. And just when authorities stepped in, the situation revealed an uncomfortable truth. The institutions that caused the crash were the same ones considered too large to fail. It's almost ironic. The players who took the biggest risks were protected, while ordinary people paid the price. Why? Because structurally, the system relied on those institutions more than those institutions relied on the system. That's the power dynamic nobody talks about. The crisis wasn't just a financial failure, it was a psychological one. A moment where incentives, egos, and unchecked optimism collided with the hard reality of risk. And here's the part that still puzzles many. Why didn't anyone stop it? Truth is, several people tried. Analysts warned. Economists wrote papers. Even some bankers raised concerns. But the machinery was already in motion, and when humans participate in a collective delusion, individual voices are drowned out. We don't listen to warnings when the rewards are this big. We listen only when the pain hits. As markets collapsed, governments injected capital, central banks cut rates, and regulators scrambled to restore order. But the deeper story is what it revealed about human behavior. When adversity strikes, people don't act strategically, they act emotionally. Some protected themselves early, others froze. Institutions fought for survival in ways that intensified the chaos. The crisis was a mirror showing us the uncomfortable truth about ourselves. We don't manage uncertainty well. We deny it until it becomes unavoidable. And the craziest part? The crisis didn't end with a single event. The aftershocks changed how economies function, how governments regulate, and how global power is distributed. It altered entire generations' relationship with money, risk, and trust. Even today, the fingerprints of 2008 are everywhere, in housing prices, in interest rates, in the rise of populist politics, in the skepticism people feel toward financial institutions. Now let me leave you with something to think about. If human psychology helped create the crisis, and human psychology shapes nearly every financial decision we make, then what stops the same cycle from repeating? We like to believe regulation or technology will protect us, but systems don't prevent crises. People do. And people are still vulnerable to the same biases, the same fears, the same illusions of safety. The real lesson of 2008 isn't that a bubble burst. It's that the most dangerous moments in finance aren't when things look risky. They're when things look perfectly safe. That's when vigilance fades. That's when pressure builds quietly. That's when the smartest people in the room start believing their own narratives. So the next time you see a market surging with no downside or institutions promising guaranteed returns, pause for a second. Ask yourself the question almost nobody asked back then. Who benefits if I believe this? Because once you trace the incentives, the story becomes much clearer. And maybe, just maybe, you'll see the warning signs before the rest of the world does.